Welcome to the deep dive. Today, we're kind of challenging one of those big beliefs about investing.
Hmm. Which one is that?
You know, the idea that you need to be some kind of financial whiz, always hunting for the next big thing to, build real wealth.
Ah, the stock-picking genius myth.
Right.
Exactly.
Yeah.
But what if the real secret isn't about being brilliant or even lucky? What if it's just common sense?
And what if the best strategy is actually, well, almost unbelievably simple? So simple it goes against almost everything the financial industry tells you.
That's the core idea, isn't it? And it's the foundation of John C. Bogle's philosophy.
It really is. So today we're taking a deep dive into his seminal work, The Little Book of Common Sense Investing.
Yeah, and this isn't just another finance book, is it?
No, not at all. It's more like a masterclass. It explains why long-term investing just works better than chasing short-term speculation.
And the huge value of diversification.
Huge value. And crucially, how something most people barely notice costs can silently, well, erode your entire financial future. So our mission today is basically to pull out the absolute key nuggets from Bogle's thinking. We want to help you really understand how markets actually work.
And most importantly, how you can make sure you get your fair share of the returns that businesses generate over time.
Okay, so Bogle highlights this fundamental conflict, right?
Yes, exactly. He frames it as the magic of compounding investment returns, battling against the tyranny of compounding investment costs.
The magic sounds good.
Oh, it is. He shows how that magic, the compounding returns, can turn just $1 into something like $30 over 50 years. That's assuming a, reasonable 7% annual return.
$30 from one. That's pretty powerful. But then there's the dark side, the tyranny.
That's the flip side. The tyranny is how those costs, even if they look small, like 1% or 2% a year, they compound too. And they can quietly eat up a massive chunk of that wealth you could have built. They just diminish your gains year after year silently.
Okay, so to make this really clear, Bogle uses this great little story, right? The winner's game versus the loser's game.
Yes, the parable of the Gottschalks family. It's brilliant.
So set the scene for us. The Gottschalks family.
Okay, imagine this family, the Gottschalks. At the start, they own everything, like 100% of corporate America, all the businesses.
Nice position to be in.
Absolutely. So they get all the dividends, all the earnings the companies reinvest. They capture the entire economic pie, 100% of it.
Sounds perfect. Almost too perfect. What happens next?
Well, human nature kicks in. Some family members start thinking, hey, maybe I can do better than everyone else. They start trying to pick individual stocks.
Trying to outsmart the rest of the family.
Exactly, which immediately leads to things like taxes on their trading. And then they think, this is complicated, I need help.
Ah, enter the helpers.
Precisely. They hire helpers, stock picking experts, money managers, maybe consultants. And of course, these helpers all charge fees for their advice and their services.
Okay, so the helpers arrive, fees get paid. What's the final score? How much of that pie is left for the Gottschalks?
It's actually quite shocking. Because of all these costs, the fees, the extra taxes from trading the family's share of that pie just shrinks dramatically.
How much are we talking?
Bogle uses an example where it drops from that initial 100% all the way down to maybe just 60%. Think about that. 40% of the return is just gone, consumed by the activity of trying to beat the market.
Wow, just evaporated into costs.
Pretty much. It highlights that wealth is often lost not just to bad markets, but to the costs of playing the game.
And then there's the wise old uncle in the story. He sees this happening.
Yes, the sage of the family, he sees the shrinking pie and offers some incredibly simple advice.
Which is?
Get rid of all your helpers. Just stop trying to be clever. Go back to the original strategy.
The passive strategy.
The passive, productive strategy of simply holding all the stocks, owning the whole market, and basically doing nothing.
So bringing that parable back to us, to you listening,
Yeah.
What's the core lesson here?
The lesson is fundamental. If you look at all investors together, in aggregate, we are the market. We own the businesses.
Right, we own the whole pie collectively.
Exactly. So, logically, the only thing that can consistently reduce the total return for all investors combined is the cost of playing the investing game. Fees, taxes, churn, trying to beat each other just subtracts from the whole.
Okay, that makes sense. It's a zero-sum game after costs.
Or really a negative-sum game after costs.
Yeah, right. So this leads us into Bogle's next big point. What actually drives stock market returns? He breaks it down, doesn't he? Economics versus emotions.
He does. He says total return comes from two places. First, there's investment return. That's the real business stuff, the dividend yield you start with, plus the growth in company earnings over time. Think of it as the intrinsic value, the economic engine,
Okay.
the
Crucial
fundamentals.
fundamental.
And the second part, he calls it speculative return.
Speculative sounds less solid.
It is. This is all about changes in how much people are willing to pay for those earnings, the price-earnings multiple. And this part is driven mostly by investor emotions, market sentiment, what Bogle famously called the sound and fury.
The daily noise.
The daily noise, exactly.
So Bogle crunched the numbers, right? Looked back over a really long time, like 116 years.
Yeah, a massive data set.
What did he find actually drives returns over that long haul? Is it the business economics or the market emotions?
And here's where it gets really, really interesting. Over that century-plus period, almost all the market's return came from the investment return part.
The business fundamentals.
Yes, the dividend yield and the earnings growth. That accounted for about 9.0% average annual return.
Okay, 9% from the real economy. What about the speculative part, the emotional PE changes?
Almost nothing. It added only about 0.5% per year on average over that entire 116-year period.
0.5%. That's tiny compared to the 9%.
It's practically a rounding error over the long term.
So wait, if long-term returns are almost entirely driven by the slow, steady economics of businesses, then all that daily market volatility, the ups and downs, the news headlines, that's mostly just the emotional, speculative part.
That's exactly Bogle's point. Paradoxically, the short-term sound and fury is dominated by emotion, by speculation. But the long-term result is almost entirely about the underlying economics.
So what's the big takeaway for us investors then?
It's pretty clear. You cannot reliably predict those short-term emotional swings. Nobody can, consistently.
Don't even try.
Don't even try. But the long-term economics, the growth of businesses, that's surprisingly predictable over long periods. So the advice is straightforward. Ignore the short-term noise. Focus on owning a piece of those productive long-term businesses.
Okay, ignore the noise, focus on the long term. But how? If trying to pick the winners or time the market is a loser's game because of costs and emotions, what's Bogle's solution?
His solution is elegant in its simplicity. The index fund.
The index fund. Explain that simply.
He famously described it as buying the entire haystack instead of searching endlessly for that elusive needle.
So you're not trying to find the best stock.
No, you're just buying all the stocks, or at least a representative slice of the whole market, like the S&P 500. It's a low-cost, broadly diversified portfolio designed to simply match or track the overall market's return.
It sounds, well, almost too easy. For people who've been told forever to beat the market, just matching the market feels counterintuitive. Does the data actually show this buy the haystack strategy works?
The data is overwhelming. It really is.
Yes.
Just look at the periods from 2001 to 2016, the S&P 500 index, that simple haystack. It outperformed 97% of the actively managed large-cap funds trying to beat it.
97%.
97%. It's not even close. And Bogle says this isn't luck, it's just the relentless rules of arithmetic. Costs matter.
Ah, yes, back to costs, those relentless rules. Let's hammer this point home because it's maybe the most important thing. What does Bogle calculate is the real long-term damage of costs?
It is absolutely devastating when you see the numbers. He shows that paying just 2% in annual costs, just sounds small, right?
Seems manageable.
Over 50 years, that 2% per year can eat up something like 61% of your potential total return.
61%.
Gone.
Gone. You, the investor, are left with less than 40% of what the market actually delivered. You took all the risk, put up all the capital,
Right.
and the financial intermediaries, the helpers, essentially walked away with the majority of your return, having risked nothing. It's staggering when you frame it like that.
It really is. And it's not just Bogle saying this, is it? You mentioned even industry legends agree.
Oh, absolutely. Peter Lynch, the legendary manager of the Fidelity Magellan Fund, famously said the average person would be better off in an index fund.
Wow. From him.
From him. And John Fossil, who used to chair the Investment Company Institute, the fund industry's own trade group, he stated flatly that the average fund can never outperform the market in total because of costs.
Even Jim Cramer.
Yeah, even Jim Cramer, Mr. Stockpicking himself, admitted Bogle's arguments were so compelling he was thinking of joining him rather than trying to beat him. That's quite the collection of endorsements. And this logic, the cost logic, it applies to bonds too, not just stocks.
Exactly the same principle. Bond index funds consistently outperform most actively managed bond funds over time.
Why is that?
Again, primarily costs.
Yeah.
The data from that same 2001-2016 period showed 85% of active bond funds failed to beat their benchmark indexes. The math is relentless, whether it's stocks or bonds. Low cost wins.
Okay, low cost wins, index funds win. But Bogle talks about another problem, something he calls the grand illusion.
Ah, yes. This is fascinating.
It's this idea that investors often do worse than the funds they invest in. How does that even happen?
It seems crazy, right? But the data shows it. Between 1991 and 2016, the average mutual fund reported, say, a 7.8% annual return.
Okay, 7.8%.
But the average investor in that exact same fund only earned about 6.3% per year.
So they lost 1.5% per year compared to their own fund. Why?
It comes down to behavior, investor behavior. The simple truth is, money tends to rush into funds after they've had a period of good performance,
Chasing winners.
chasing past winners. And then, when performance inevitably dips, money flows out. People sell low.
Buying high, selling low. The classic mistake.
It's the classic mistake, driven by emotion and performance chasing. And that bad timing erodes the actual returns the investor experiences.
Which ties right into another key concept, reversion to the mean, RTM.
Exactly. The powerful tendency for things to return to average over time. Yesterday's high-flying winners often become tomorrow's laggards.
Is there data on that? Like, how often do top funds stay on top?
Oh, yeah. There was a study looking at Morningstar's 5-star rated funds back in 2004. These are supposedly the best of the best.
Right, the elite.
10 years later, only 14% of them still had that 5-star rating. 14.
Only 14%? What happened to the rest?
Half of them, 50%, it dropped down to 3 stars or even fewer. And other studies looking at fund performance quintiles, dividing funds into 5 groups based on performance, found that only about 13% of funds that were in the top 20% performers in one 5-year period managed to stay in that top 20% for the next 5 years.
Only 13% stay at the top. What about the others? Do they just fall a bit?
Well, get this. 27% of those initial top performers actually ended up in the bottom 20% in the following period.
From top to bottom. It really is like flipping a coin, isn't it?
It essentially is. As Daniel Kahneman, the Nobel laureate, said, that disclaimer, past performance is no guide to the future. It's not just legal text, it's mathematical reality.
Nassim Taleb's coin toss analogy. Streaks happen, but they don't predict the next flip.
Precisely. It's randomness, largely. So trying to pick next year's winning fund based on last year's results is like, well, Bogle called it searching for a needle in a haystack. It's mostly futile.
So given all this, the costs, the emotions, the reversion to the mean, what is Bogle's ultimate winning formula?
It's beautifully simple. Own the entire stock market through a low-cost index fund. And
then what?
Then do nothing. Just stay the course. Hold on through thick and thin.
Let the market work for you without getting in the way.
Exactly. Take your emotions completely out of the equation. It's powerful because it works. Even Warren Buffett, arguably the greatest active investor ever.
Yeah.
He directed that 90% of the trust for his wife should be put into a very low-cost S&P 500 index fund.
Even Buffett buys the haystack for his family's future.
Even Buffett. He recognizes the power of simplicity and low costs for the long run.
Okay, so let's broaden the view slightly. We've talked about index funds, costs, staying the course. What about putting it all together in a portfolio, asset allocation?
Right, how you split your money between different types of investments, mainly stocks and bonds. Bogle emphasizes how critical this is.
Oh, critical.
He cites studies showing that something like 94% of the differences in portfolio returns over time are explained simply by the asset allocation decision, not by stock picking, not by market timing, but by how much you have in stocks versus bonds.
94%. That's huge. That's basically everything that matters for results.
It's the dominant factor.
But Bogle also has a warning about the future, doesn't he? About expected returns.
He does. He cautions that we should probably expect lower returns going forward than we've seen historically.
Lower how?
Well, maybe it's something like 6% per year for stocks instead of the historical 9.5%, and maybe around 3% for bonds instead of the historical 5% plus. After costs and inflation, he suggests a typical balanced portfolio might only return close to zero in real terms.
Oof, zero real return. That's sobering. So if returns are likely to be lower, what does that imply for our strategy? For how much risk we should take?
This is where Bogle offers a really game-changing insight, connecting costs and risk.
Okay.
He shows that in a lower return world, a portfolio with lower costs and maybe even a lower allocation to stocks, meaning lower risk, can actually end up giving you the same or even higher net return after costs than a higher risk portfolio that has higher costs.
Wait, run that by me again. Lower risk can mean higher net return. How?
Because costs become so much more damaging when overall returns are lower. That 2% fee might not have seemed terrible when the market was returning 10%, but if the market's only returning 6%, that fee is suddenly eating a third of your gross return.
Ah, I see. The impact of the cost is magnified, so chasing higher returns with expensive funds might actually leave you worse off than just sticking with a cheap, perhaps slightly less aggressive index portfolio.
Exactly. It completely reframes how you should think about risk and cost together, especially looking ahead.
Does Bogle give any sort of rules of thumb for figuring out your stock-bond split?
He mentions the old rule of thumb, your age in bonds. So if you're 40, you have 40% in bonds. But he stresses it's very flexible,
Not rigid.
not rigid at all. Younger investors might easily be 100% in stocks. He also talks about maybe moving beyond just U.S. stocks and bonds.
Like a three-fund portfolio.
Yeah, adding an international stock index fund for global diversification, a simple, low-cost, three-fund global portfolio. He even makes a neat point about thinking of your Social Security benefits as being like a bond holding when you calculate your overall allocation.
That's clever. Integrating all your assets. What about when you're actually in retirement? How should you take money out?
He leans toward a total return approach. Don't just rely on dividends. Combine the dividends with selling off a small, regular amount of your capital.
Is there a safe withdrawal rate?
He mentions the common 4% rule as a starting point, withdrawing 4% of your portfolio value in the first year, then adjusting for inflation. But again, he stresses flexibility.
Meaning,
Meaning if the market has a bad year, maybe tighten your belt and withdraw a bit less. If it has a great year, maybe you don't need to take the full inflation increase, or you could even reinvest some. Adaptability is key, because nothing is guaranteed.
okay, so we've covered a lot of ground here. Costs, index funds, emotions, long-term thinking, asset allocation.
Quite a journey through Bogle's common sense.
But if you had to boil it all down, the central message from Bogle is really about simplicity, isn't it?
Absolutely. The majestic power of simplicity and parsimony, thriftiness in investing. It really is, as you said at the start, unbelievably simple to capture the market's returns. Own the market. Keep costs vanishingly low.
It's profound stuff. There's that great quote from Paul Samuelson, the Nobel laureate.
Oh, the one about the index fund, yeah.
He said Bogle's creation of the first index fund was the equivalent of the invention of the wheel, the alphabet, and wine and cheese.
Yeah. Think about that. The wheel, the alphabet. Fundamental things we can't imagine living without now. Things that stood the test of time because they just work.
That puts it in perspective. So the final thought for you, our listener. You put up 100% of the capital. You take 100% of the risk.
All of it.
So why on earth should you settle for less than your fair share of the market's return? Why let costs and unnecessary activity erode what you've earned?
It really is time to apply these common sense principles. Think about the power of low-cost diversified index funds. Think about the discipline of just staying the course.
Your future self will definitely thank you for it.